We had problems over at Livestream, and looks like we have 60 minutes here to get this webinar done. So I'm going to have you guys leave questions for the end. We'll do Q&A at the very end, and then I'll be happy to answer your questions as we go along. So let's get started. So let's talk about volume. As you guys know from the pre-flight checklist, there's certainly a number of indicators that you always need to go through, and I highly recommend watching, if not re-watching, the pre-flight checklist webinar, which I discuss all the critical components that are required to, that one's required to go through before trading any kind of stock. So volume, very simple definition: number of shares or contracts traded in a security or in an entire market during a given period of time. So very simple. You should always be checking the number of shares traded of a stock, whether it's in the pre-market, after some news has come out. Obviously, you always want to go back to the longer-term charts, the 100-day, 200-day, 1-year, 2-year, 3-year, 5-year, 10-year charts, as we always talk about, to see the historical nature of the stock in terms of its trading volume. And volume really is critical when it comes to determining whether a stock is tradable or not. So let's talk about the ABCs of volume. Ideally, you want to focus on penny stocks with above average volume of 1 million shares or more traded per day, and typically this will be far above the average shares traded for any particular penny stock. So the stock's obviously up for some reason, whether it's earnings, whether it's a contract, whether it's sector hype, or a pump, etc., etc. And I go over all of that stuff in the pre-flight webinar. So really, this is volume goes hand in hand with everything else that we talk about. So very important to look as I will stress over and over at the historical charts to see if a stock has had volume and can spike significantly, as we talk about in terms of former runners. So it must have a history of spiking, 100% or more ideally, and traders remember stocks that have run in the past, and you don't want to get yourself stuck in a stock that is not liquid. So pretty simple stuff here, guys, but believe it or not, many newbies get involved in stocks that are just not very liquid, and we'll talk about it later, but sometimes stocks are volatile. However, they're not very liquid, and even with a volatile stock, you have to really eliminate certain candidates from trading because of the volume, and I'll talk more about that in a little bit. We'll go over some important charts. Okay, so low volume stocks are not good risk reward unless swing trading for many days and weeks. Pretty self-explanatory. Again, don't get stuck in a low volume stock that's only trading 300,000 or 400,000 shares in a day. That's just not enough volume to really take a sizable position. And the last thing you want to do is get stuck in an e-liquid stock. So let's talk about ideal versus non-ideal charts. And let me move this over. All right, so let's talk about these two stocks here, AMMJ and CBDS. And as you guys know, the marijuana sector was a super hot sector in during the past couple of months, and you can see the run-up started in September. And we'll have a side-by-side comparison. You can see this is AMMJ, actually a stock that Tim had bought this morning, I guess it was yesterday. And you know, it's really, the run-up started in September. You can see that also on CBDS, the run-up started in September here as well. Both stocks had pretty good volatility, but you'll notice here on AMMJ, look at the volume. The volume increased gradually over during the run-up, and typically a good trading day for this stock was 3+ million shares a day, 2 to 3 million. You can see at the very top it traded 4 million on the first red day. It traded well over 6 million. Now let's compare that to CBDS. CBDS, you have a big run up from the 2s all the way up to the 8s. So in terms of percentage, AMMJ is certainly the winner. It ran from 20 cents to $2. That's a 10 times your money. CBDS ran from 2 to 8, so it was roughly a 300% winner from the run-up, from the beginning of the run-up to the top. So once again, both quite volatile, but understand that AMMJ is far more liquid, and you can take a far more sizable position. And you know, let's say you're buying the breakout here at $1, a key whole number after the stock's consolidated for many days, and you know, you had a 50% win in 2 days. And you could certainly have bought CBDS in the 450 to 5 range and held it all the way up to 7 or 8, but look at the volume. The volume was only a few 100,000 shares, and it's just not going to trade a very tight spread, and it's harder to get. It's hard enough to get executed in the bulletin boards, and you really need to choose the plays that are most liquid. And AMMJ is a good example of a stock that, you know, has the volatility, but also the volume and the liquidity to take a sizable position. So pretty self-explanatory here. Make sure that you're looking at these indicators before trading. Here's another one, ideal versus non-ideal volume charts. We're looking at 2 biotechs here, and biotechs have been very hot in the past few weeks and months, and you can see that these charts actually look pretty similar. September, you had a big run, followed by a big drop, followed by a big run-up. Same thing here on AST. You had the big run, gradual fading, and then a bounce right back up to brand new highs. The difference is, apart from the fact that CARA was an earnings winner and had a good a nice bounce off of the bottom here in the sixes. The volume really tells the story here, and you can see that the initial run-up had very good volume, trading well over 1 million shares a day for a large part of that initial run-up. And once you have that good response to earnings on 4 to 5 million shares, that is a very healthy volume to consider trading. Now let's compare it on this side here with AST. You've got very, very poor volume. The volume never hit 1 million shares on this run up, on this bounce back from the low threes. And even though it did end up almost doubling, the stock never traded more than 400,000 or 500,000 shares. And that's just, it's enough to take a small position. But as I write here, the volatility is acceptable, but the volume below 1 million is not ideal. And CARA, you really had that increasing volume, and that should be a very clear indicator to you guys that this is a far better candidate to trade, with also keeping in mind that it was an earnings winner, it's in a hot sector, it's a biotech play, and all the indicators that we typically look at, as I discussed in the pre-flight checklist webinar, really fit the picture, so to speak, in this case. So CARA clearly a very, very good candidate to buy and ride all the way up. Certainly wouldn't have held it for this many days, but you can buy the first day of the bounce, hold it for perhaps a day or two, and this thing bounced from 6 to 9, which is a 50% run in 3 days, and the volume really tells the story here. So again, really focus on this incredibly important indicator. So let's talk about another couple of charts. These are 2 more biotechs, AUPH and CRIS. AUPH, all of you guys that have been trading for the past few months, if not longer, should know this stock very well. And it initially ran from $1 to $2.50, going back to the mid-August. Then October, it had the big run and squeezed all the way up to $5.75. But the important thing here to note is that it had 2 trading days of 30 million shares. That, to me, that tells me that this is a very, very liquid stock. Traders will remember it. It's volatile. It ran from 2 to 6 in just a few days, and when the biotech sector started bouncing, this was a great candidate to consider buying. And the volume doesn't look that healthy going back to November, the early to mid-November. However, it was still trading 2 to 5 million shares in this run-up, and you can see that this big wick here was the dead top. I was shorting it on that day and covering it the following day, and now you can see that it's really faded back down. So the volatility was there. It had a historical volume that was very good and very healthy, and we compare that to, or contrast that to CRIS, which never really traded more than 1.5 million shares, apart from this one big volume bar here. So CRIS, if you look up the float, as you should be doing for any and every stock that you consider trading, CRIS has a much bigger float, and thus it will require uh, a significant amount of volume to really move the stock. And you can see that it moved from $1.80 to 360 at the top, or 350, call it. But look how many days it took, and the volume never really broke out of its normal range. So I think it's pretty crystal clear here that CRIS, even though this was you could say a technical breakout through 2, you would have had to have held it a week and a half, 2 weeks just to get to 250. And yes, if you did hold it, you would have had some nice profits. But look at the chart on AUPH and remember that you could be focusing on a far better setup because of the volatility, because of the volume, and the catalysts as well. So very important for you guys to choose the right stocks to trade, and a lot of you guys focus on plays that are not that volatile, and it's even worse when, you know, it's bad enough to focus on stocks that are not volatile, but when you have plays that are far better and you're missing out on those other plays, that makes it even all the more you know, frustrating because you're not focusing on the right ones. So I can't stress that enough to really look at the volume, see if it's had big spikes on unusual, or should I say, you know, exceedingly high volume days, you know, that are well outside of the normal range of the trading volume for that particular stock. So AUPH, if it trades 30 million shares, it's just blowing past anything that it's ever traded. And you can see with CRIS, no incredibly excessive volume days that would lead me to believe that this stock can really do a whole lot more than maybe go up 20 or 30 cents in a day. And we're not looking for stocks that can only go up, best case scenario, you know, 5 or 10% in a day. We want stocks that can go 20, 30, 50%, even 100% sometimes. And as you guys know, low floaters typically fit that criteria. But you really have to line up the different indicators that I talk about in the pre-flight checklist, and then use that in combination with the volume to really figure out what the best plays are. So I'm just going to check on one thing. Bear with me. All right, so let me go ahead and make this full screen. I apologize if you guys, and I will go ahead and share this PowerPoint presentation with you guys afterwards. So all right, so let's get back to the presentation. Once again, for those of you joining in now, please write down your questions. I'll go over them at the end of the presentation so we can just get through everything first. So we talked about ideal versus non-ideal volume charts. Let's talk about classic newbie mistakes. I go over a number of your watch lists for challenged students who email me, and so often you guys are looking for stocks that perhaps are looking to break out and are, you know, somewhat volatile, but they're just too slow. They're moving far too slowly, and they're not candidates to really consider trading. And you can see that CVEO here is a biotech. I believe it's a biotech, but the point is it ran from $1 to $1.80. Looks good, right? Well, the most it ever really moved was 20 or, looks like 15, 20 cents, 15 or 20 cents in one day. And that's just not acceptable. That's not enough volatility. A newbie might look to buy the breakout of 180 and sell it in the twos. But remember, this chart, I don't have the longer term chart, going back to several months before this, but the odds are is that it's probably going to find resistance in the low twos. Is this a stock you want to really trade? And even more so, look at the volume, folks. Volume is well below 2.5 million. It never traded more. Even in the prior 6 months, never really did anything. And there's nothing in this chart that really would lead, nothing that really leads me to believe that it can spike 30 to 50 cents, maybe $1 a share. And that's probably because the float is very large. It's a stock that's not very heavily traded. It's not a former runner. And traders focus on volatility, and this is not a chart that you ever would want to consider trading. So again, volume, very clear here. I've drawn a line. It never had volume of more than 2 million, 2.5 million, and never really moved more than 10 or 20 cents a share in a day. And that's just not the prime candidate for a stock that we would be looking to trade. So let's look at another one, VUZI. A lot of you guys are familiar with this company. I actually bought it. I can't remember if it was back here, where sometime in the July time frame or in the early September. I think it was in the early September time frame. But once again, let's look at the volume. The volume is pathetic on this stock, and it's traded under 1.5 million shares pretty much this entire 6-month period, other than a couple of days which turned out to be the dead top. And when you have a stock that it can run and appears to be volatile, it ran from 575 to 8 in 4 days. That's good, but on a few 100,000 shares, that just does not cut. That does not cut it. And there's far better opportunities out there, especially in this bull market, to be focusing on other plays that are far more volatile, far more liquid. And you can see historical volume is well below 1 million shares, and you've got to avoid these type of plays. So once again, focus on plays that are breaking out to new highs on excessively high volume. And here you can see that the volume did increase somewhat, but the stock has never really been that volatile on significantly high volume, and that is why it's never really run. So pretty basic stuff here. Even I make mistakes sometimes, and you will make mistakes too, but recognize these mistakes and look to avoid trading charts like this, charts that are very thinly traded, and while they might move 50 cents a share in a day, thinly traded stock can easily reverse on you pretty quickly and drop 20, 30, 40 cents a share, and then you're stopped out of your position or you panic sell, and that's just a frustrating situation to be in. So avoid trading these kinds of setups. So let's talk about classic opportunities, and I couldn't think of a better chart or a better sector to discuss than the shipping sector. As you guys know, that the shipping sector caught fire with dry ships, DRYS, going parabolic from $5 or $6 a share all the way to 115 at the dead top. And the reason they ran, apart from the fact that they were shippers, obviously sector plays can run much further than you think, but they were also low floats. And once dry ships went full supernova, then you got to start thinking about other shippers. And SINO proved in the past that it could run significantly when it had volume. And again, look at the volume here: 10 million shares traded, not once but twice within a few days, and the stock ran from 1 to as high as 3. So this was a very classic indicator. The chart's telling us the stock can gap and run 200% on 5 to 10 million shares. So again, looking at this chart's history is very indicative of what you can expect in the future. So we focus in on the November run-up. You had dry ships running, as I talked about. I'll show you a chart of dry ships in momentarily. And the volume was fairly limited until the big blow-off top volume day. But once the stock started testing the highs of this initial run-up, namely the $2 area, you can see I drew a $2 resistance area. That was really the key area to consider going long. And the risk reward was fantastic, buying it in the twos. The worst is you maybe lose 20 cents a share, with the upside of making $1, $2, $3, $4 a share. Nobody expected this thing to go to as high as 13, but understand that history is on your side, and you'll often hear Tim talk about being a glorified history teacher. This is really what he's talking about, and what you have to realize is that the volume speaks for itself. When a stock gets significant volume, it can run as it proved back in August, and that is why that you have to really consider. There were several plays in the shipping sector, but SINO was certainly one that proved it could spike, and it certainly was a big winner. And of course, on the flip side, on the reversal, I'll talk about volume exhaustion. It was a fantastic short as well, but a number of shorts got wrecked trying to short into this parabolic action, thinking that the $3 perhaps was the top. And that is why these things go parabolic. You have so many early shorts, and when a sector gains so much momentum, like the way dry ships did, and then of course CNO, and let's talk about SHIP, another play that again proved it could run. This stock had traded 5 million shares back in August, and it ran from 3 all the way to 7. It ran another time from 4 all the way to the 7s on roughly 5 million shares. So again, remember that history is on your side. If a stock has the volume in prior run-ups, i.e. it's a former runner, then it's likely going to do the same thing again. And it really all comes down to volume. You need to have the volume come in, and once this volume started to come in on this candle here, as it started going through the $2 level, that was the time to buy. And in fact, I was buying this in the I believe in the 230s or 240s, and selling in the 280s, 290s, I believe, far too early, as it ran all the way up and retested the dead top from the prior run-up. So again, recognizing volume former runners with volume. And this should all be straightforward to you, but too many of you guys are forgetting to go back and look at the volume to make sure that the stock is liquid enough to really take a sizable position. So ideal volume, former runner, and a hot sector. That's really the name of the game. You've got to really hone in on these things, and of course this was a low float as well. And eventually they did an offering, and the stock tanked, and you know, now it's really in the final phase of the rundown. But I'll go through some questions. I'm seeing some questions pop up here. Once again, I'll go through questions here shortly. I just want to get through the last few slides before I go into the Q&A session. So dry ships, this was the big run. You had volume come in, 5 million shares on the first run-up day, and you know, a lot of people thought that this was a crazy move from 5 to 10. A lot of people thought it was crazy at 20, at 40, at 50, 60, and 70, and this thing did run to $115 before it was halted, and it reopened for a short time at 50 before tanking, and now it's all the way back down to where it started. So these are the kind of plays that you live for, and volatility in a hot sector, especially in plays that are low floats, that are easily manipulated, that are heavily shorted, if not naked shorted, meaning there's more shorts involved in the stock than even the number of shares exist in the float. So if the float's, let's say, 500,000 shares and there's 3 million shares short, this is something I actually tweeted about. I said that there was probably, you know, 5 to 10 times more shares short than there were in the float, and that is what causes these epic run-ups from 5, 6 all the way to 115. So sector mania only happens a few times a year. This year we had the shippers. We've had biotechs running, obviously not to this extent, but biotechs were hot. You had the marijuana sector, and using these indicators that I talk about, the volume indicator is very, very important when deciding which plays to choose, which plays to trade. You have your main runner. In this case, it was DRYS, DRYS. Then you had SINO, which came in as a sympathy play, but SINO was really the leader of the sector, other than DRYS. And SHIP, I would say, was a sympathy play that was also an excellent candidate to trade, both on the long side and the short side. Plenty of volume and liquidity. So let's talk about some volume exhaustion setups, also known as climax tops. And what I'm talking about here are stocks that become overextended, primed for reversal, as the last line of buyers, including amateur shorts, are covering near the top, and you have lots of buy-ins going in. So, you know, these are the type of plays. This is what I'm talking about: volume exhaustion. When a stock. Well, let's just talk about the other bullet points before I refer back to the chart. So, typically you have 1 to 2 days of increased volume, 50 to 100% higher volume than prior run-up days, and I'll show you some examples of that. And the stock goes full supernova, and that is the number 3 step in penny stocking framework. All of you guys should have watched penny stocking framework. I refer back to penny stocking framework over and over again, and that will help. That DVD will help you see these patterns over and over and over again. But the point I want to stress here is the volume, and looking for indicators with the volume that that a stock is nearing its volume exhaustion, it's nearing a climax top, and shorts are nearing a point in which they're taking over, and the reversal, the momentum reversal, is about to happen. So using volume as an indicator is absolutely pivotal. What should you do? Look to short the first red day after a failed morning spike. So we'll talk about that shortly. Nothing new here. Again, this is bread and butter strategy from Tim's Penny Stocking, or Penny Stocking Part 2, amongst many other DVDs. And the volume is just a critical indicator to use when considering the bigger picture of a stock and the risk reward, and looking to participate in a momentum reversal. And I think another takeaway from here is that you can also ride up a stock and look for that big volume exhaustion to sell into. When you have a big, massive volume exhaustion, that signifies a clear indication to sell, and you really have to respect the volume from that standpoint. And let's talk about a few stocks here that we talked about earlier in the presentation. We'll talk about CARA, dry ships, CNO, and SHIP. So again, let's look back at the volume. You can see that the volume surged on the 14th and the 15th to 10 million. You can see that it doubled the volume from the prior 2 days, and everyone thought again that this was the dead top, but it did manage to squeeze up to 115 the prior day, but the volume was not really there because of the halt. And the important thing to note here is that you would not want to ever be long into a parabolic move like this, because even though it did go to 100, anybody that was long from the 60s or the 70s, even the 50s, they were not able to likely get out in time once the stock unhalted. So again, using volume as an indicator, the volume doubled from 5 million to 10 million. It had 2 days of excessive spiking, and that was a clear indicator that you should be looking to get out if you were certainly looking to get out if you were long, and then getting ready for the short side as well. In this case, it was extremely dangerous because because of the volatility in the pre-market and the ability of these kind of plays to gap up or gap down. So let's take a look at SHIP. Again, you can see the volume hit 12 million, which was 5 times the prior volume day. Looks like on the 14th. So it looks like it did roughly 2.5 million the prior day, and then it did 12.5 million. And when you have a stock that does excessive volume like that, again, it's going to take. It's just not reasonable to expect a stock to go higher after an exhaustion day, a volume exhaustion day like that. Does not mean that it can't go higher. And it did go higher. It gapped up, but the following day, you can see that. Okay, so actually I'm getting a little bit ahead of myself. So we had two exhaustion days. One was 12 million, one was 10 million. So in this case, you had the two volume exhaustion days, and then we get back to what I was saying earlier. It's very tough for a stock to continue spiking on this kind of volume, and this is what happens after all the early shorts and the late momentum buyers are they're running for the doors at the end, and then you have the first red day, the failed morning spike, and this is a clear short after two big volume exhaustion days. SINO really only had one volume exhaustion day, and but it did have a massive gap. And if you were long from the prior exhaustion from this day, anywhere between the fours, in the fours, fives, or sixes, this stock, offered a very nice win if you held it overnight. Obviously, it gapped up tremendously, but the point is, once again, it had that volume exhaustion. It never traded this many shares, didn't even come close in the prior run-up. And again, use the volume as an indicator to really assess whether or not this is a good hold overnight or not. And typically, as I said, you get 1 or 2 days of volume exhaustion. Let's talk about CARA. You can see here, this is not necessarily a supernova, but it is a stock that kind of fits this volume exhaustion pattern that I talked about. And you can see the dead top, it traded over 5 million shares. That was 60% more than the prior 3 or 4 run-up days when it first started spiking. And again, this was an indicator that the volume was exhausting. We're reaching a climax top, and no surprise that it crashed from the 12s all the way down to the 9s. And I remember trying to short this in the 9s, thinking this was a double top. Now it, is 9 is holding as support. But again, this was a solid shorting opportunity on the first red day, and then a fail at the 12 area, and once again, more fading all the way back. So again, look at the volume, look for those volume exhaustion days. Typically, you have 1 to 2 of those days that exceed the prior day's volume by 50 to 100%, if not more. And that is how you can really use volume to predict the coming price action. And ultimately, you want to look for reversal patterns. And some of you with smaller accounts obviously need to focus on the longs, but some of you as well, even with small accounts, you can take small positions and look to short the first red day. So with that said, I'll take some questions, and we'll do some Q&A, and I'll be happy to pull up some charts and answer any questions you guys have. So let's take a look at some questions here. Okay, so Morris was asking how we get this webinar to rewatch. We'll post it, don't worry. Ben will take care of it. So that'll be posted on Profitly. Don't worry, you'll have access to this webinar. Um, Matthew's asking about buying a stock into the close on Wednesday. Let's limit the questions to volume, guys. I really want to focus on volume here only. So if you do have questions about what I spoke about earlier, please go ahead and I'll be happy to answer. Mags mentions that daily volume is fully known by the end of the day. How would you gauge good levels for specific periods in the day, i.e., for 1 minute in the first hour? Yeah, that's a good question. So you really, again, you want to look at the volume from the prior run-ups. You know, the stock needs to have had prior, um, you know, big spiking on significant volume before, and typically you will see significant volume come in the first 30 to 30 minutes of the day, and I think it's pretty safe to look for a morning spike on a stock that has the catalyst, that has a good catalyst, whether it's earnings, whether it's a hot sector, and you have to, sometimes you just have to take a chance. But certainly by the afternoon, you'll know whether or not the stock has traded enough volume to really um, garner enough interest from from the day trading uh, world, so to speak. All right, so Richard McBain asks about uh, HADV. He said he had it on his watch list as a potential long and a break above 80 cents. He missed the buy. At the same time, it was only trading 100,000 shares near the market open. Yeah, so HADV, um, tough to really. Let's pull up HADV. Very strange that it's not coming up. I'm not going to pull up my E-Trade Pro. I don't want to risk disconnecting with the webinar, so we're just going to go ahead and look on Yahoo Finance. HADV finished at $1.30 today. But again, the volume on this play was very mediocre. It looks like it traded, okay, it traded 1.9 million shares today. So not a bad trading day in terms of volume. Yahoo Finance has been giving trouble. I'm not sure what the deal is with them today. So HADV was volatile. It's a risky play to be dip buying a stock that's down, 80, 90%. But on the other hand, it was moving on very small volume. It's okay to take a tiny position. Understand that the stock's trading, and I can't seem to get a chart for HADV. This is just frustrating. Let's see here. All right, so the volume today was we're going to try go to OTC markets, and I don't believe that they do charts. All right, so there's the run up, the big crash, and the bounce. It ran from 80 cents to $2, but yes, the volume was only 1.6 million, and if you're buying this, you've got to be quick. You've got to be in and out very, very quickly and meticulously. OTCs are very, very tough when it comes to execution. Even when there's significant volume, it's tough to get out, and in this case, there's very limited volume. So I don't recommend buying OTCs unless there's significant liquidity. Otherwise, you're going to get stuck. So very small positions, okay. Make sure to have your orders in. Make sure you have a broker that gets you good executions. Matt Abraham asks, there's no way to predict volume exhaustion. You know, it's not an exact science, but understand that if a stock is squeezed significantly on it, you know, massive volume, then it's likely to do it again. And so, especially with a shipping sector, with a hot sector, with perhaps an earnings winner if it starts to get overextended, but especially pumps. Remember, Tim always talks about shorting pumps. Well, that's not a secret. It's not a secret strategy. There's certainly a number of short sellers that have been using the strategy for many, many, many years, shorting pumps, and you can expect to see some kind of volume exhaustion or some type of climax top on a pump and dump that has, you know, 1 to 2 million shares of volume traded, you know, during the run up, because excuse me, you're going to get a number of big traders and big positions that are bought in, and typically on pump and dumps you will see some kind of volume exhaustion, like I talked about. You'll typically see 1 to 2 big green bars with volume that's 50 to 100% more than the prior days, and that would signify the end of the run-up, or near the beginning of the end of the run-up. So Frank asked about watching for a catalyst. Let me check on time. I just want to see how we're doing on time. Looks like we only have 2.5 minutes left, so I'm going to answer a couple more questions, and then we can certainly continue another discussion during my next webinar. But Frank says, earlier I mentioned that we need to watch for a catalyst in conjunction with volume. I have to go back and review the pre-flight checklist, but can you give a quick example of what a good catalyst looks like? Very straightforward. A good catalyst is a hot sector. It's a stock that's had good earnings. A good example is exactly what I talked about, SINO, DRYS, and some of these other plays that ran because the sector caught fire. Thomas asks about scanning for volume. Yes, you always want to look at your volume. Always look at the biggest percent gainers, and then sort them by volume. If you're looking tonight for the top gainers today, and you find a stock that's up, you know, 28%, but the volume was 70,000 shares, forget it. So always look to scan the percent gainers and then sort it by the volume as well. Todd asked if there's a acceptable percentage float that I look for. How do I compare floats to current volumes? I'm not exactly sure what you're asking, but Todd, essentially you're just going to look for stocks that are ideally 10 million shares, a 10 million share float or less. It's okay if it has a higher float, certainly. There are many stocks, especially in this market, that we've seen, many stocks running 100, 200, 300%, even with higher floats. Matt asks about going over intraday volume as an example of when to go long. That's just typically times of day. Either you're looking for a morning spike or an afternoon run-up or a big dip. So refer back to penny stocking framework in terms of when to look to get into a stock, but make sure that you're always looking at the volume for any particular I'm not sure if we're still on or not, but make sure you're looking for any for any given stock. You're looking at every volume level for prior run-ups or the current run-up before you decide whether or not it's something that you're going to trade. So with that said, we're going to close out here, guys. If you have questions, please email me or save your questions for next time, and I'll be happy to go over any of this material that you're not clear on. But once again, focus on all the indicators that we talk about, especially the ones I go over in the pre-flight checklist, along with the volume indicators that we talk about and that I've stressed over and over in this webinar.
My name is Tim Sykes, and I teach people to trade stocks. I am a self-made multimillionaire.
So this is the ideal trade that I'm going to talk about. I want you guys to understand every single aspect of this trade.